the head office was in the business of doing some back office or call center services to third parties, and they also do the same thing for my other unit, then the answer is explainable, yes, that you need to cover these transactions. But simply because this is a common facility which is being shared amongst 5 units, it doesn't become a marketable service. And there is a tribunal decision which clearly supports this fact, not in this particular context. It's the decision of Nahar Spinning, which talks about that these services are not subject matter of ATI 8, they are subject matter of ATI 5 or 6, which requires that all allocations should be done in a right manner before you compute the profit. So there is no question of transfer of service, and hence ATI 8 is not triggered, and hence you need not report this particular transaction. As I understand, initially there was a complete view, a consensus amongst most of the companies and the generally that these transactions are reportable. But I believe that based on this particular interpretation, I think we can take a clear stand that this is not reportable. Only thing you need to be cognizant about the fact is that is this some kind of a service which is marketable. If it is marketable, then clearly. So something, let's say one unit is supplying electricity to the other unit, clearly it is a marketable service. But where there are common facilities, which is more for the purpose of sharing of cost, it is not intended to be a service. Yeah. So that's the reason that we can take a stand that these transactions are not subject matter of but this will not apply in case of ATI 10, because ATI 10 it's not a question of cost allocation. It's actually a cross charge happening from one company to another company. Now, in that scenario, it would be a little difficult to take the same premise to say, because ATI 10 also doesn't talk about transfer of goods and service, it talks about ordinary profits, which factors in even the cost allocation. So even if you were to take the stand that this is a cost allocation between two companies and is not a service, still, for the purpose of ATI 10, this would be relevant. Now there have been questions surrounding, and this is a very vexed question, and I don't know what answers to finally land up on this. But if you look at there could be a head office which is undertaking the research and development, and there are units which are manufacturing, and most, let's say in the case of pharmaceutical companies, all units are manufacturing, their head office is doing research and development. The question will come in whether that research and development cost needs to be allocated while computing the profits of this particular undertaking. Now, this has been subject matter of litigation, and finally the conclusion of the decisions coming from the courts is that in most of the cases, the courts have laid down saying that when you want to look at the inter-unit allocation of expenses, there are certain expenses which need to be allocated, certain expenses which need not be allocated. So there is a Madras High Court decision in the case of this decision. Tidewater Oil Company Limited. Now in this decision, the court has clearly said it's not necessarily every expense of head office needs to be allocated. Only if that particular expense is directly relevant for the functioning or the manufacturing of that unit, only then you allocate. And there are some more other decisions which, if you want any of interest, I can just lay down. There is another decision of Hindustan Liver. Again, this is Madras High Court, where the court said that all the expenses which are of general administrative nature need not be allocated for the purpose of computing the. Now, in other decisions of Zandu Pharma and other decisions, what the court said, especially in the context of R&D, again the court said that in one of the cases, the court said that you need not allocate the R&D expenses, and the reason being, the court said that what the head office is doing is actually doing R&D for future, and the products which are being manufactured, for that they don't need this R&D. So this is not directly relatable to the manufacturing of this particular product currently being undertaken by the unit. But if you look at it broadly, generally the understanding is any expenditure which is at the head office, you just do an allocation on some kind of allocation team. But here are the decisions which will surely help you to remove all these expenses out so that you can actually increase your tax holiday. So these decisions, if you really fall into these particular category of expenses which are completely dealing to the functioning of the unit, then you first remove them out completely. Don't even allocate. You have a support available. Second, after you have allocated the expense, there are second basket which is an allocable. You decide whether it's a marketable service or it is a non-marketable service. Only if it is a marketable service, then that will get subject covered under the SDT. If it is a non-marketable service, you don't need to again report it. So just broadly don't go and categorize, okay, head office expenses, common expenses, allocate and divide amongst all of them on the basis of an allocation deal. Look into it, try and remove some expenses, don't allocate them at all, even for the computation of the unit. For the purpose of computation of unit, break them into two parts, allocable, non-allocable. In most cases, I would say, in most cases, these common expenses which are allocable would not form part of SDT, so not required to be reported.
So, in case pharma company is doing an R&D in-house as well as contract R&D, so that the total R&D should be allocated or only the R&D which is pertaining to the contract R&D should be allocated to the eligible R&D?
So your question is that there is a pharma company which is doing R&D,
contract R&D and in-house R&D.
And in-house R&D. So when you say that they are doing in-house R&D, for whom they are doing?
For captive consumption, as in for their own products which will be manufactured.
And then why are they doing contract manufacturing for the other? See, contract manufacturing means they are doing for somebody else. So it is contradictory.
Contract R&D, they will assign R&D job to outsiders.
They would do R&D for somebody else because they would have some additional facilities that would be available or some additional capacity. So if they do a contract R&D as well as the in-house R&D.
Okay, so the point is you are doing R&D on the basis of which you are doing some manufacturing. There is a spare capacity available for which you are doing a contract R&D. Clearly, when you are doing a contract manufacturing, first of all, whether who could be the manufacturer in that particular contract manufacturing to claim the tax holiday. If you get categorized as a manufacturer, then I don't think the R&D cost has any link to this particular manufacturing activity. So you need not allocate that. But for your existing manufacturing facility, if this R&D is relation to that particular manufacturing or it is relation to the future research for new products, that is what you have to distinguish. If it is in relation to the future products, then you have a support available to say that you need not allocate those R&D expenses right now. But if they are in relation to the current manufacturing which is happening and you need to constantly upgrade that and use that as a part of the process, then you should allocate that. Okay, now earlier you heard about 2 views, then you heard about 3 views, now you hear about 4 views. So yeah. So this ATI 10, it talks about, as we saw, talks about closely connected person. Now, closely connected person is nowhere defined in ATI 10. So what is the meaning of ATI, closely connected person? Because if we do not know the definition of that, then how do we cover the transactions which are within the ambit of ATI 10? Now, one view is that you look at what is the definition given in 48(2)(b) of related party. And why you should look at that? Because when you look at the form 10CCA, which is for the purpose of claiming the tax holiday or computing the tax profit, in that form somewhere they are talking about closely connected person and they are making a reference to 48(2)(b). So that gives an inference that the intention of the law is maybe to refer to 48(2)(b) relationship. Second, 92A. When this section got amended, SDT, and there was this rule 10A which was introduced. In that particular amendment to the rules, they have actually defined associated enterprise shall have the same meaning assigned to it in so 92A and in respect of. So somewhere they are trying to link it to the SDT. So maybe that is giving a flavor that let's look at 92A definition, and more so it is also in the context of international TP within the ambit of chapter 10 where now SDT also resides. So let's look at 92A also. The third definition is the accounting standard AS 18 where the separate definition is given of what is related parties. And the third is take all of them. Now, here I would.
You just said 188, section 188 also.
Yeah, right. So, but
5 years.
yeah, now the 5 years. That's you're right. So, but somewhere it is now almost similar. But you're right. We can always take that particular thing. So, if you look at it, which would be the one to take out of this? Because API 10, this is completely silent. It says with closely connected person. Now, where do I get a meaning of that? The intention. Let's go to the intention. It is trying to cover transactions wherever it is giving more than ordinary profits. And in that section itself it's saying, or for any other reason. Now they are saying not only for the relationship but for any other reason. Meaning thereby even if the relationship is not there but somewhere you are able to arrange, they are trying to plug that. So in such cases the intention is to cover all scenarios where the transactions are generating more than ordinary profits. In light of that, it would be better and I would say conservative to consider all the parties which are defined in all these sections. You can't leave it around. And then, because what will happen is tomorrow if somebody puts an allegation, it will be very, very difficult and these penalty consequences are very onerous. And if, let's say, you do not fall in 48 to be definition, but you fall in 92A, what would say, see, somewhere the court is, the act is trying to bring that relationship under 92A. You may not fall under 48 to B, but 92A similarly is intended on the same lines. And if you have arranged your affairs with them on those lines, then you need to cover. So I would suggest, my view would be is to really, there is no guidance available, but the best approach to this particular solving this mystery is, if you are falling in any of these definitions, please treat them as covered for the purpose of API attempts. Yeah, now the excess profit versus short profit and international versus domestic PP. Now, clearly, more in the context of API 10, when you are making more than ordinary profits, that's the reason which is the area of concern, and those particular profits need to be disallowed. If the profits are less, then the question is not there. And if you look at it, there are certain judicial precedents in the context of, especially in the case where there are a lot of cases where in international TP, the SSC had made a profit of, let's say, cost plus 80%. And the TPO came with the comparable benchmark was 40%. So TPO accepted, saying yes, I'm okay with that. But the AO started to disallow that, saying that, oh, you have actually earned excess profit. So I'm going to disallow that under the API 10. Because they are earning, the premise of the AO was that you are earning much, much more than the price determined by the TPO as the ELP. So it's like a double-edged sword which started. A lot of cases underwent that particular litigation issue. Now, clearly, if you look at it, the moment a transaction is an international transaction, it is outside the purview of SDT. As in case a transaction is SDT, then you have those methods applicable. If it is not SDT, then the old law or the unamended law continues, prevails, where you do not have any recourse or reference to the 6 methods. In those particular scenarios, what does it happen? So in such cases where the assessing officers or the TPOs have tried to contest that assessing is sending and earning profits from exports, they are making huge profits and they are trying to abuse and claim excess tax holiday. All these matters went to the court, and by and large, it went in favor of the taxpayer on a number of arguments. So specifically, these 2-3 cases which I have just presenting the substance or the summary of that is, in that case, there was a JV in India, 70% owned by overseas, 30% by the Indian entity. When the export happened, what the arguments were produced by the taxpayer saying that, look here, if you believe that we are trying to get excess profits into India, then remember one thing, and from my overseas parent, then 30% of that actually is going to the JV partner. No commercial man would want to do that particular thing. 2, why does this concern of API 10 come in? Because if somebody claims a higher tax holiday, there is another taxable unit who is getting a higher cost and reducing their tax liability. Here is the case where I am exporting. In any case, that is never available as a deduction in India. So So where is the erosion of the tax base? In fact, if I were to bring lesser money, and let's say 40% instead of 80%, then there would be a loss to the Indian government. And how? Because if the less profits set in India, when I declare the profits back, the DDT will reduce. And third, the fourth point, in that particular benchmarking the TPO adopted, there was one of the comparable was 87%. So court said that the ALP and the fair market value or the ordinary profits, they are two different concepts. You cannot bring both of them on the same parlance. There is nothing in the law in case of an international TP that you say you will have a benchmark with the ALP as ordinary profits. So the assessing officer has to work out that how he is saying that ordinary profits in this case would have been 47%, especially when one of the comparable in their case was around 97%. So there is one comparable which is earning 97%, so that becomes a reference point. ALP somewhere you bring out one number, but in case of ordinary profits or in case of FMB, it could be a complete range. So on all those premises, the court ruled in the favor of the taxpayer, and this has been some similar kind of a similar trend where courts have been holding in favor, where this kind of good arguments are available. So if you were to just look at the, so I've covered the measurement case. Okay, the only tweak to this now would be is, let's look at excess versus short is over. Let's look at international TP versus domestic TP. If one unit, which is let's say enjoying a tax holiday, is exporting some goods to its overseas A, and it is also selling the goods in the domestic market and enjoying the tax holiday, let's say it's a backward unit, so it gets a tax holiday from both sides. The issue would be, when it goes to international TP, I need to earn profitability above the comparable margins. But when it comes to sale in the domestic market, I need to earn profits lesser than that. So there is a conflict between an international TP and domestic TP, and I've covered one of the case studies on that to see how we can try and resolve that particular situation. Because you're on the face of it creating a contradiction for yourself. So either the TPO will say, I make an adjustment, or the TPO will say, I'll make an adjustment on a domestic TP. Okay, now the way we do self-adjustment in international TP, can we also evaluate or consider these kind of self-adjustments for the purpose of tax holiday when we're talking in the domestic? So if you just look at a working of this, a very simple case where a taxpayer is eligible for ATI, chapter ATI, and the issue is where they are buying something from another company and then you want to make it's an excess price. So let's say if you were to really make a self-adjustment and you say, okay, I bought an excess price, I'm making an adjustment and I'm increasing my profits, and thereby I'm claiming higher tax holiday. Now since in this case, because the self-adjustment is made by myself, not the TPO, 92C4 proviso will not be applicable and I should still be eligible for the tax holiday. Because this 92C4 proviso is also applicable to adjustments made by the TPO for tax holiday units. So I'm sure you're aware that when this proviso works that in case if I claim a tax holiday and adjustment is made by the TPO, then I'm denied tax holiday on it. So what I will do here is, in case at the time of filing the return, I realize that yes, I have overpaid than the market price based on my benchmarking, then I should make an adjustment and then claim a higher tax holiday. Because if the TPO were to increase my profits, then that will not be eligible for the tax holiday. But let's say we do it kind of a so reverse scenario where the AO does it, then there is going to be an excess, the extra tax liability which will come in. So merely by you being a little sensitive to the filing of the return, if you make a self-adjustment where you genuinely believe that there is some kind of a TP adjustment to be made, you can be salvaged from this particular payment of excess tax. Okay, so let's look at some quick case studies. So no problem, I think we can go pretty fast because the issues are broadly covered. We can just look at it. So let's look at a case where there is MCO, which is in the manufacturing of soaps, and it is claiming ATIC benefit. Now, MCO is holding 20% stake in DECO, which is a domestic company and a distributor company, tax-paying company in India. It's just a simple distributor. MCO sells goods to DECO, which is the domestic distributor, as well as sells the goods to its overseas AE. Now, overseas AE is actually branding the product in its own market and then selling the goods. And DECO is selling the goods in the name of MCO's brand. Now, if you look at it, MCO's profit margin for sale to overseas AE is 15%, and its sale to DECO is generating a 20% profitability. And the industry broadly benchmark is around 10%. Now, in light of this, let's look at what would be the implications coming out of it. And the questions, first of all, would be is, I have a benchmark which talks about generally companies like me earning 10% profit. I am earning 20% profit from sale to my domestic company. I am enjoying tax holiday on that. And I am getting 15% profitability from sale to overseas company. So on the face of it, prima facie, it seems okay. On international TP, I am better off because benchmark is 10%, I am earning 15%. But for a domestic company, for the sales to the domestic, I am earning 20% profits when my benchmark is 10%. So let's see, not to jump on the prima facie, let's go into the specifics of it. Yeah? So let's look at the solutions, what could be the cases. Obviously, since the sale is happening to the overseas group company and they are selling in their own brand name, and they are, I would say, full-fledged distributors, and they could be also categorized as their complex entity, I would tend to look at benchmarking using myself as a tested entity for this particular transaction, and I would benchmark myself saying that the benchmark is 10%, broadly the similar companies are earning, and I am actually getting 15%, so I am completely at arm's length on that. And this would be clearly supported by my fact that the overseas company is investing in the market and they will be repacking, branding, different small packages, everything, whatever it is. So they are selling it on their own brand name. Now, coming to DECO. Now, DECO is a scenario where if we just go by the same approach of testing, using myself as a tested entity, then I'm surely facing an adjustment. But the point is, now here is a case where we need to get into file access and see that what is the function which is being done and which is the right entity to be selected as a tested entity. So here is a case for which we will select the domestic, the D company, the distributor company as a least complex entity and adopt that as a tested entity for the purpose of my domestic transactions. And since the domestic company is earning maybe 5% or 7%, which is comparable from their sale, my transactions are not overly priced. And hence, I should not be denied a tax holiday even if I am earning 20% profits from sale to this particular distributor. So this is how, like, if we get more and more specifics and try and segregate all our the heart of transfer pricing, which I called as the FAR analysis, if we get into the answers will be there for us. So this is one of the reasons which we can just try and look at it. Now, just a variant of that was, if suppose okay, so whether sale of goods to both DECO and AEs at cost plus can be justified. So obviously, as I said, we need to really bring out a distinction that both are different. We don't want to use them as a comparable basis. And obviously, if I were to work on a cost plus 10%, then separately benchmark, use the comparable and work it out. Okay, let's look at the second case study. These case studies will be very simple for us because we have discussed the issues in the past, so we can just try and implement those particular issues into this practical situations. Now, this is a case where we have a holding company which has two separate companies. One is a PECO, which is a power unit which supplies electricity both to MCO, and which is a group company engaged in manufacturing of products, and is not enjoying any tax holiday. So it's a non-tax holiday unit, MCO. And it is also selling, supplying power to third parties. PICO is claiming a tax holiday, and PICO charges third parties at the rate of 10 rupees per unit supplied. Now, the point is, and this may not be the exact example which may happen in practice, but there's a conceptual discussion which is very important. That's why I brought this particular case study. What will be the implication if there is no charge, or let's say a very negligible charge by PICO to MCO for supply of power? So here we are also thinking from not only from the tax holiday but from 37(1) perspective. So the moment I am not claiming an excess tax holiday, clearly for the PICO which is supplying the power unit, nobody can touch it from a SDT perspective. And for MCO, because it is a taxable unit and they are getting at a lower price, 48 rupee also doesn't apply to them. But interesting, or the very important point would be is, can the expenses incurred by PICO be disallowed to it, saying that could there be some expenses incurred as to why they are selling at a less than market price when they are selling to third parties at 10 rupees per unit, and if they are selling at significantly less price and which is resulting in a loss, there could be some kind of a contention that are we incurring expenses on behalf of somebody else's business, and there could be 37(1) issues due to which our, in case even if we have losses, the carry forward of those losses could be questionable. Third case study. Holdco, PICO is a tax holiday unit supplying power to MCO, which is also a tax holiday unit. So both are tax holiday unit. PICO is completely supplying at a cost plus 10% markup to it. The questions to be looked at is, what would be the implications for transaction between PICO and MCO if the arm's length margin works out to 15%? So currently the transactions are happening at cost plus 10, but the arm's length margin works out to 15%. Now clearly from a PICO perspective, I am charging less than the arm's length, so my tax holiday is not more than ordinary, so I have no issue. But when you come to the other side, MCO, can the contention be there that I am earning more than ordinary profits because somebody else is giving me at a lesser price? So there is where the possibility of some kind of a disallowance of tax holiday happening. And especially in a group which is enjoying having a lot of tax holiday units, this is going to be the biggest issue, where you'll consistently find that one unit having been disallowed a tax holiday, and possibly another unit also facing some kind of a disallowance because of 42, 48 to be disallowances, which I will cover subsequently, and there could be a double whammy to it. So the net substance message is that now going forward, dealing at arm's length ALP is extremely critical. Earlier you had a long band of broad range within which you could transact, but now going forward you will have to transact very, very microscopically in a particular small range. If you do outside that, then you are very, very likely to face adjustment. And this is what I was saying, that let few years go and you will find significant amount of litigation happening on all these kind of issues. Similarly, if let's say the arm's length price was 8% and I have actually sold at cost plus 10%, in the same as a variant of that, then I have actually earned more than ordinary profits. But let's say if I am able to fit myself in the plus minus 3%, then I will still be home. But if I don't, then it's a excess tax holiday and will be disallowed. At the same time, for the entity who is buying goods from me, which is MCO, they are buying, instead of cost plus 8, they are buying at cost plus 10%. So they are buying, they will not have an excess tax holiday under 80 item issue, they will have a 48 to be issue. Are they overpaying from a related entity? Because here the transaction will still be hit by 48 to be. So if they fall in the plus minus 3%,